Hello and welcome back to the program. I'm Emily, and today we're diving deep into a phenomenon sweeping across the American economy. A surge in activity that looks promising on the surface, but which some experts warn could be nothing more than a mirage, a temporary inflation of the numbers driven by fear and uncertainty. We're talking about the ripple effects of potential import tariffs, specifically those championed by former President Donald Trump, and how businesses and consumers alike are reacting in ways that could paint a misleading picture of economic health. The situation is becoming increasingly tense, with the specter of significant import taxes looming, particularly on goods from China. American businesses are reportedly engaging in what's being called precautionary buying. This isn't just routine inventory management. This is a strategic maneuver, a race against the clock to bring goods into the country before the tariff hammer potentially falls, driving up costs dramatically. It's a move born out of necessity, a calculated risk to avoid potentially crippling price hikes that could decimate profit margins. Austan Goolsbee, the respected president of the Federal Reserve Bank of Chicago, has shed crucial light on this trend. Speaking recently, he highlighted how this precautionary buying is likely widespread among businesses. He stated, and I quote, "This precautionary buying is probably quite prevalent among businesses. We've heard a lot about inventory building, maybe for 60 or 90 days out, should the uncertainty rise. Think about that. Businesses aren't just ordering for next week or next month. They're potentially stocking up for a full quarter, anticipating a period of significant instability. This isn't normal market behavior. It suggests a deep-seated concern about the future availability and cost of crucial goods. But it's not just businesses. Consumers are also caught in this wave of anticipated price increases. The analysis suggests that individuals are accelerating their purchasing decisions, particularly for big-ticket items. Why wait until the fall to buy that new iPhone when it might cost significantly more than due to tariffs? This immediate gratification, driven by the fear of future expense, is pulling demand forward. It's creating a temporary spike in retail sales and consumer spending that might not reflect underlying economic strength or confidence, but rather a defensive posture against expected inflation. Mr. Goolsbee warns that this sudden rush to buy, both by businesses building inventory and consumers making accelerated purchases, could artificially inflate economic activity in the short term. He predicts that the economic data for months like April could look surprisingly robust, even hot initially. However, he offers a stark warning about what comes next. He forecasts that by the summer, this activity could sharply decline because, as he puts it, everybody bought everything already. This creates a distorted economic cycle, a boomlet followed by a potential bust, making it incredibly difficult for policymakers and analysts to gauge the true health of the economy. It begs the question, are we witnessing genuine growth, or merely the economic equivalent of pulling future demand into the present? The sectors most vulnerable to these tariff impacts, and therefore most likely to exhibit this stockpiling behavior, are those heavily reliant on imported components and finished goods, particularly from regions facing the steepest tariffs. Mr. Goolsbee specifically pointed to the auto industry as one where significant inventory building is likely occurring. Consider the complexity of modern vehicle manufacturing. It relies on intricate global supply chains, with countless parts and components sourced from around the world. Many of these, especially electronic parts and specialized components, originate from China. The situation with China is particularly acute. As the analysis points out, goods from China currently face a staggering total tariff rate of 145% upon entering the United States. 145%, let that sink in. This isn't a minor adjustment. This is a prohibitive tax that fundamentally alters the economics of importing from China. It's a rate that forces businesses to make incredibly difficult decisions. While the focus is often on China, it's important to note the broader trade landscape. The U.S. has reportedly postponed applying reciprocal tariffs with other economies for a period of 90 days, with China being the notable exception. Currently, Products from most other trading partners face a 10% tariff upon entering the U.S. This 90-day reprieve is set to expire around July 9th. This temporary pause creates another layer of uncertainty. What happens after July 9th? Will those tariffs increase? Will they remain at 10%? Will they be removed entirely for some partners? Mr. Trump is reportedly pushing for trade negotiations with these countries during this window. Mr. Goolsbee highlights this uncertainty, stating, "We don't know 90 days from now, when they revisit the policy, how big the tariffs are going to be. This lack of clarity makes long-term planning incredibly challenging for businesses. It forces them into short-term, reactive strategies like stockpiling, rather than investing in stable, predictable growth. It's a high-stakes game of wait and see, with significant economic consequences riding on the outcome of these negotiations. The impact on individual businesses is palpable." We heard from Matt Rollins, the CEO of Dragon Glassware, a company based in California that manufactures drinking glasses. His company imports from China, and the 145% tariff presents an existential threat. He described the agonizing decision of having to temporarily leave goods in China because bringing them to the U.S. would mean facing that massive tariff. A 145% import tax would translate to a retail price increase of at least 50%, a jump he believes would cause customers to simply stop buying. His company currently has enough inventory in the U.S. to last until June, and he is desperately hoping the tariffs are rolled back before then. This isn't just a theoretical economic problem. It's a real-world challenge impacting jobs, businesses, and livelihoods across the country. This situation forces us to consider multiple perspectives. Is this tariff strategy a necessary evil? A tough stance required to rebalance trade relationships and protect domestic industries? Or is it a blunt instrument with significant unintended consequences, disrupting supply chains, increasing costs for consumers, and creating artificial volatility in the economy? Some might argue that the short-term pain of stockpiling and price adjustments is a necessary transition towards a more domestically focused or diversified supply chain. Others might see it as a self-inflicted wound, damaging the very economic stability it aims to protect. There's also the question of the data itself. How reliable are economic indicators when they are being skewed by these extraordinary, fear-driven behaviors? Can policymakers make sound decisions based on numbers that might be artificially inflated in one quarter only to collapse in the next? This creates a fog of uncertainty for the Federal Reserve and other economic bodies trying to steer the economy. Despite the immediate instability and the financial strain on businesses like Dragon Glassware, Mr. Goolsbee maintains a degree of optimism regarding the long-term economic outlook for the U.S. He reminds us that the economic data prior to April was quite positive. The economy was operating near full employment. And importantly, inflation was trending downwards. His optimism seems rooted in the underlying strength of the U.S. economy before this tariff uncertainty became the dominant factor. However, he acknowledges the public's sensitivity to inflation, stating, "It's just that people don't want to go back to the period of 2021 and 2022, when inflation was totally out of control." This public sentiment adds another layer of pressure on policymakers to avoid anything that could reignite inflationary pressures. Even if the immediate surge in activity looks like growth, the narrative here is complex. On one hand, we see businesses and consumers reacting rationally to perceived threats, trying to mitigate future costs. On the other hand, this very rational reaction is creating an potentially irrational distortion in the economic data, making it harder to understand what's truly happening. Is this a temporary blip? A necessary adjustment period? Or the beginning of a more prolonged period of trade-induced volatility? The coming months, particularly as the 90-day grace period for other trading partners expires and the full impact of the China tariffs continues to be felt, will be crucial in revealing the true trajectory of the American economy. It's a situation demanding close observation and careful analysis, as the line between genuine economic momentum and a tariff-fueled illusion becomes increasingly blurred. This is a summary and analysis built on a massive language model,